millennials and baby boomers may have more in common when it comes to investing than you might expect. Here to tell us why is Gina Bolvin, president at Bolvin Wealth Management Group. Thanks so much for making time for us today, Gina.
Thank you so much for having me.
So this jumped out to us because, I mean, when you think about investors and their priorities, they tend to be quite different because, you know, maybe your millennial or your younger investor has a far different timeline than an older investor might. But what sort of similarities do you see out there?
Well, we're actually seeing similarities between millennials and their grandparents, more so than millennials and their parents. And I think, and I think what's so interesting about that is the Great Depression to their grandparents is really what the Great Recession of 2008 is to millennials, and both generations have been scarred and somewhat leery of stocks because they came of age at a time when the stock market, completely collapsed and took a long time to return.
So they would be more wary about taking those risks then.
Absolutely. So, we're citing a Bank of America study that we've seen, and I'm actually seeing it in some of my clients who are baby boomers. Baby boomers have a much higher risk tolerance to stocks than you would think, even though they could be in their 60s and their 70s now. Baby boomers came of age in the 1980s when the PE of the S&P 500 was at a much lower amount than it is today. So they came of age at the start of a secular bull market, and the market did very, very well through the 80s and the 90s. So their investment experience with stocks led them to believe that stocks are a much more safer investment. Whereas millennials almost have, the opposite effect. Millennials came of age in the 2000s during the dot-com bust. And if you had gotten invested in the 1980s, your average rate of return is about 10 to 11%. But if you got invested like millennials did in the 2000s, your average rate of return is down to about 6%.
So, I mean, that's really interesting, especially when you think about, the long-term impact of that. If you aren't in the market, then, you might not benefit from a payoff down the road if you, go a more conservative route right from the beginning.
Exactly. And what we're seeing with baby boomers is there's a constant buy the dip mentality. And that's even what we're seeing this year. Look at what's even happened this year with the historic interest rate hikes that we've seen, even a regional banking crisis. I woke up that day and I thought I would be getting calls from clients saying, oh no, here we go again, 2008. But I actually had some of the opposite calls where clients were calling and saying, should we get more aggressive? Just last week, a baby boomer client called to buy NVIDIA stock. So, kudos to them, right? They also are at an age where defined benefit plans have gone away and they've had to be more self-reliant on their own investing skills and their own 401k to get them through retirement.
I'm curious, the interest in GICs this year that has really, picked up. Who might you be seeing interested in that? Because you think older, but maybe some of those younger millennials as well.
Well, what we're seeing in that millennials, because their experience hasn't been as good or as strong as their parents, they're more apt to invest in alternative investments. And by alternative investments, we would mean, commodities, real estate, cryptocurrency, and even art.
Right.
So, they're more apt to try to find another solution to seeing how they can make money and get through retirement.